just like her outlet, tall, dark and handsome, and he's a chip on his shoulder, but that never stopped him. She was just like his mother, face as pure as her heart. She believed anything he'd say about a fresh start. And as the moonlight fell, well, so too did they, at a dance at the crossroads, to the music they sway. Passes by and they were dancing still. The boys had passed comments like, Johnny, you know the drill. So he got down on one knee, since she was a wife to be. And he was just like her outlet, fond of a bottle or two, caused himself enough trouble, but he muddled on through. She was just like his mother, oh, she'd never miss church. She prayed for the others in spite of her own hurt. As the clocks and calendars turned, so too did they, at a dance at the crossroads, to the music they sway. To the music they sway.
Please take your seats. The program is about to begin.
This little thing called love, we're doing it half-heartedly, just steady enough. Oh, this little thing called love, doing it half-heartedly, just steady enough. Oh, this little thing called love, doing it half-heartedly, just steady enough. Oh, this little thing called love, doing it half-heartedly, just steady enough. Oh, this little thing called love, doing it half-heartedly, just steady enough. Oh, this little thing called love, doing it half-heartedly, just steady enough. Oh, this little thing called love, doing it half-heartedly, just steady enough. Oh, this little thing called love, doing it half-heartedly, just steady enough. Oh, this little thing called love, doing it half-heartedly, just steady enough. Oh, this little thing called love, doing it half-heartedly, just steady enough. Doing it half-heartedly, just steady enough.
I started thinking I should open my mouth and let the words out, yeah. Let the words out, yeah. I know they'll happen if I only allow them. They'll come as a crowd, yeah. Out as a crowd, yeah. Dear happy, don't go. Not there, but I'm close. I just always.
Please take your seats. The program is about to begin. Please welcome to the stage Bloomberg's Caroline Hyde.
Morning. Thank you everyone so much for coming, for breakfasting with us, and really for diving in on what is going to be a fascinating discussion around technological innovation, change, and the money that is currently powering it. I'm Caroline Hyde, lucky enough to co-anchor Bloomberg Technology, the daily tech show. But today, I'm here with Bloomberg Invest, and I just want to thank the fact that we are proudly sponsored by Invesco QQQ. This is all about transformations, technological advancements, and some of the money, and in particular, some of the private money that has been fueling all of this. Now, we're going to talk about what's dominating the headlines. Tiny bit of geopolitics. But no, really, we're talking about artificial intelligence here. And the next leg of it, how are we starting to see the value be accrued? How are we starting to see the monetization be really felt from generative AI? And I want to be talking a little bit about the private capital that pours in, whether it's from family offices, whether it's in the latest and greatest developments in climate tech, for example. We're going to do it all. First of all, though, I want you all to take out your phone, because this is an interactive experience, folks. But we don't want it to be so interactive that you're receiving calls. So please make sure that it's on silent, but then please get busy and start dialing in on this QR code, because we're going to give you everything when you log in. It's going to bring you the launch page. You're going to get your Wi-Fi, always integral when you're in places like this. But also, you're going to be able to play along with our sessions, ask us questions, know where you're about to go next after this delicious coffee break. So please do make sure that you're playing along with us throughout. And indeed, get social. Be following our hashtags and make sure that you're giving your perspective to some of our conversations. Hashtag Bloomberg Invest is where it's at, and also at Bloomberg Live is if you want to follow what's happening across all of the major platforms. Also, you're lucky enough to potentially get a bit of a subscription in on the deal today. If you don't already subscribe to Bloomberg.com's news, you should, and there's discounts, so please make the most of that. But let's get started in what is the first of today's incredible conversations. I'm so lucky to be welcoming to the stage founding partner at ICONIQ Capital. It is Michael Anders. He manages the investments, the portfolios of some of the world's most influential business and tech families. Please do welcome for a deep conversation with Mike Anders. Thanks for getting up early with us.
Thank you, my pleasure. Good to see you.
Don't all be too upset about the gorgeous tan that this man has. He's a busy surfer and thinking a lot about the climate impact on the oceans. And I want to go so much into the work that you do in terms of impact at ICONIQ Capital. But for those in the audience who are like, I know ICONIQ Capital, I know they manage the money of some of the most important founders, remind us what the unique vantage point you have at this pretty unique moment in history.
Thanks for having me, Caroline. It's really a pleasure to be here. I would say first, ICONIQ was started with this idea of surrounding ourselves with a client base of founders and CEOs, a lot of Silicon Valley tech entrepreneurs. The idea was we would spend a lot of time listening to people that were exceptionally smart, exceptionally relevant. It probably would surprise a lot of folks that the client base of ICONIQ has expanded beyond Silicon Valley. It's as many non-tech founders and CEOs as it is tech founders. It's a lot of families and CEOs around the globe, outside of the US. And the simple premise that the more time we spent listening to folks like this, the smarter we would become on their behalf. And so we really have tried to curate this exceptional group of founders and CEOs across industry, across geography, across sectors, with a belief that collectively a group is smarter than any one individual. And then the relevancy of this group collectively would source a lot of really interesting investment opportunities for the group. And in that vein, about 10 years ago, I guess closer to 12 years, we launched our first private investing fund, ICONIQ Growth, which was focusing on enterprise software. We're now investing out of our 7th fund. And as we saw sort of this migration to the cloud, it created an interest in the railroads or the data centers to support that enterprise sort of migration to the cloud. And so we began investing in data centers. And I think today we're one of the largest landlords for some of the hyperscalers in building and investing in data centers around the world. And so having such a central role in these conversations and engagement with such interesting founders and CEOs across industry has really allowed us to see a few themes. One is, this sort of migration to the cloud I mentioned a second ago was very, very real. And that obviously led us to see the need for infrastructure. And then it also gave us insight into some of these shifts that happen every decade or so in terms of tech platforms. And when you see so much capital going into these industries, there really is an exceptional need to pick the winners. And so engaging with the network over these last 15, 20 years has really given us an understanding of tech trends. And now as we're here to talk about AI and the AI landscape.
And I'm so interested to get into the rails, the infrastructure, but also what are the winners you're now betting on. And look, just yesterday, one of the key stories we were reading about was a check that you've been writing to Assured, which is helping with insurance with the world of generative AI. You are still writing checks in what is a very discomforting moment. And when just speaking to this news flow that we've had yesterday and today, the incredible unique group that you have, I'm sure everyone's speaking with everyone else, being kind of, what next? How? Where are we? Is there a level of urgency and unnerve among your families right now?
I think there's certainly, in speaking, it depends on who we speak to, but I think in spending a lot of time with consumer CEOs lately, there is definitely an awareness that there's a sentiment shift. I think the consumer is beginning to start paying attention to the uncertainty in terms of where tariffs are going to take us, and so I think that's a pause that people are feeling. From our standpoint, though, we actually like this environment.
Yeah.
It makes you do the work, and I think if you're got the team, you've got the rigor, you've got the discipline, you've got the focus, and going back to what I said earlier, this is a moment where picking the winners is so critically important. And so I think right now in this AI journey we're in, it's been a long road. I mean, AI has been around for decades.
Does generative AI become more relevant at this moment where companies are worrying about predicting the future, making sure that they're profitable? Are they even more galvanized and to lean into this generative shift?
I think in the last year or two, the awareness around Gen AI has gotten everybody sort of to the point where they know it's critically important, but it is such a complicated and nuanced situation we're in right now that I think people are starting to really know the need. They need to pay more attention. And I think it's less about the predictive nature of it. I think that's kind of where we've just come from. And now we've gone to where these machines are able to think, they're able to reason, and pretty soon they're going to be able to act. And I think the acting piece is what gets us very close to this AGI moment where machines are all-knowing. I think what's happening in parallel, and maybe it's less talked about, everyone's so focused on LLMs and smaller language models, but our focus has actually been on the just the automation and also the application integration that's happening. This kind of is our software DNA. We're looking at businesses that are actually creating product that's going to allow business to be more efficient, to optimize, to create revenue, to enhance the customer experience.
Return on AI that everyone's waiting and wondering and seeing?
And we're seeing that already. We're starting to see these businesses adopt technology that's making the customer experience so much better. It's creating revenue, and it's also allowing for product development and employee efficiency. Those things are very real, and that's unfolding in real time right now.
What I think is so interesting is just the depth of success that ICONIQ growth, but across the board ICONIQ has already had. How are you seeing those companies that you've backed long, that have already gone public? You've seen incredible exits that have actually recently happened in this dearth of IPOs. Service Titan came out. They're having to pivot in this moment too, right?
Absolutely. So a few years ago, we were talking about how there was a time when you could invest in technology as a vertical. And our view was that it was becoming horizontal, that every company in some shape or form was becoming a tech company. And we used to have arguments with CEOs of consumer companies trying to explain to them they no longer are a widget company, they're a technology company that sells widgets. I think what's happening now is as tech has become horizontally integrated across every industry, AI is now the tech stack on top of that. And so we've invested in a number of companies, and they all now are embracing AI. One of my partners we have an AI report card that we talk about every single portfolio company with. How are we doing in sort of migrating to this AI DNA, because it's going to be embedded in every single company. We look at a company like Figma, which we invested in, and I'm sure many of you know because Adobe publicly came out and tried to acquire them. This was a business that was not an AI company in its beginning, but now Dylan, the CEO, talks publicly about how AI is raising the ceiling and lowering the floor. It's allowing developers who may not be super sophisticated to use AI to decide how they want to sort of give the guidelines of the products they want to develop, and it also allows people that are very sophisticated in programming and development to use AI to become even smarter, thus raising the ceiling. So every one of the companies in our portfolio, whether they started off as a traditional SaaS business, is now embedding AI.
I mean, just thinking of the winners that you have, the Datadogs and the others in this world. But what's so great and unique about your Vantage is that you call it the tech stack. There's also the generative AI stack, dare I call it. There's the infrastructure layer, which picks and shovels are where we were at for 23, 24. Yes. And you were there because you'd seen cloud and you'd gone into the data center perspective. But now everyone's wondering about, it's not just about LLMs, it's about the application layer. From your perspective, how are you looking at where evaluations build and where value accrues in 2025? Is it the same game plan? Is it still data centers and NVIDIA?
Well, I think so. So NVIDIA, AMD, data centers, this was the picks and shovels that allowed us to get to where we are now, where predictive intelligence is now becoming generative. And I think our focus has really been on these application layer companies where there's an ability to really create enhanced customer experience, enhanced employee efficiency, and products. A company like Writer allows you to create first draft presentations through AI. It's creating enormous productivity. A company like 11 Labs, which is text to voice. Think about a streamer who produces a movie and wants to release it in 100 different companies like that. The ability to allow this real value creation in the business world and these workflows is the focus for us. We obviously are paying very close attention to the LLM race that's underway right now, and it's fascinating and amazing. It's hard for us to put capital there given where the valuations are. We tend to stick to our roots. It's a little bit of family office DNA. We hate losing money, and so we try to underwrite to businesses that have incredible tech teams, have incredible product roadmap, have customers, have something that's working, generating ARR, and we can see a really clear path to growth. And so that playbook, which worked in software, companies like Snowflake, Datadog, ServiceTitan, Adyen, Procore, we're hoping is working with AI. But also, just to be very honest, despite having spent countless hours looking at AI companies, I think we've looked at a couple thousand in the last 2 years. We've actually only written 12 checks to native AI companies.
12 out of thousands.
12 out of thousands of companies we looked at.
And what's so interesting, you think about a Snowflake has made such pivot with its CEO Sridhar coming from almost a generative AI startup to then build and where the new future of Snowflake. I don't know if you know May Habib at Writer, but I think she might beat any of you and even you in terms of air miles. This woman is flying in between London and San Francisco basically on the week. And that's why I want to go in terms of geography here, because what are you seeing in terms of 11 Labs, Writer, where this tech talent is? Is it all about American exceptionalism, or is it everywhere because you're a global company?
Yeah, so we are a global company. We have offices in Singapore and London, the Bay Area, and New York. We have invested all over the world. Of the 12 native AI businesses we've invested in, a quarter are outside of the US.
Oh, wow.
11 Labs is an example. Our view remains extremely global still. I think we saw that software and that migration to the cloud I mentioned earlier really afforded the ability for an entrepreneur to start a company anywhere, as long as you had access to Wi-Fi. I think AI is slightly different in that the technical expertise and the team needed and the access to this infrastructure makes it somewhat more limited, but innovation's coming from all over the world. And I think the US does not have the only game in town. I think you look at DeepSeek and what happened just a few weeks ago, that's a very real deal. And I think we're going to start to see incredible innovation come more globally very fast.
You must see round corners. Were you surprised by DeepSeek? Were the people you're speaking to surprised by it?
I think everybody was surprised by DeepSeek. Really? And I think when the sort of cover came off, and it was became aware to everybody, I think there was both a surprise in how quickly they were able to catch up. But I think there was also a lot of, I mean, the key takeaway was they can make this technology for cheaper than our models.
Yeah.
And this wake-up call around efficiency versus our brute force spending.
Yes.
I think that's a big wake-up call. And the other thing, speaking with a CEO recently who's deeply involved in this area, was he felt that there was a clever cunningness to their technology, meaning like there's a lot of innovation and origination coming as well. So I think this innovation is global. It's happening all over the world, and it's just going to continue that trend.
And what's interesting is when we think about global diversification, there's also diversification of what you're building for the founders and families that you've worked with for so long. Look, 2024 was marked by basically just 7 companies making up most of the public sector gains. Are we going to see a breadth again? And how do you ensure that you've got diversification across that whole generative AI stack, or indeed not just in generative AI, but other things too? Yeah,
well, I think when you look at the two sort of channels, right, you have the large language models, and right now there's the debate between open versus closed. Yeah. I think that debate is going to be a very interesting one to watch. I think when you see what happened with DeepSeek and you see what's happening with Llama, the open architecture model seems to intuitively make sense and allows for more players to get into the game quickly and more efficiently. The closed model is going to be hard. You have to raise tens of billions of dollars on a go-forward basis, right? Everyone's talking about spiking the ball in the end zone and getting to AGI. There will be multiple winners in this space, but they're going to continue to evolve and try to outsmart the next player. And so the amount of capital taken bodes well for the open model. Will that capital remain resilient, do you think? Will that capital still be there, maybe more from the institutional strategic investors that are Amazon and Alphabet rather than private? I think the capital is going to stay prevalent. What's interesting, though, about, say, a Llama or even ChatGPT or OpenAI is that they have these consumer products and there's revenue coming in that can also fund the growth. And I think that makes the products more interesting and the financing more sustainable. What about sustainability here? Because that's also the unique thing that ICONIQ offers here, is that you're thinking about helping that pool of talent, that pool of unique vantage point coming together, collaborating, helping you pick the next set of winners. But you're also thinking about these people's legacies and making sure they're diversified in terms of their portfolios, but diversified in what they want to make an impact on. How are you seeing that come into this moment of generative AI where everything seems to be up? We're thinking about different problems, about solving cancer, about healthcare, great leaps, changes in the way we're going to be able to make people healthier and wiser. Is generative AI something that you think about in your impact part of the business as well? Yeah, for sure. So just taking one step back, about 5 years ago, ICONIQ launched ICONIQ Impact. And similar to how we thought the family office environment was siloed, inefficient, lonely, philanthropy's also struggled. There are, gazillions of dollars sitting on the sidelines. It's one of the great big problems we face. There are incredible organizations that have created solutions across myriad issues, but the capital isn't able to find them. It's easy to give to your alma mater, it's easy to give to your religious institution, but it's really hard to fund climate equity, really hard to fund economic mobility, racial justice, women's health, climate change, ocean health. So we created this collaborative philanthropic model where we raise these charitable funds based on issue areas. So for example, we launched the Ocean Health Collab a couple of years ago. We funded it with about $50 million from ICONIQ families. And we always partner with an objective independent consultant who really understands the space, in this case, ocean health. And so how is AI coming into this? Well, I'll give you one example as someone who spends a lot of time in the ocean, not as much as I would like, but as a surfer. Got to manage some money some of the time. Exactly. One of the organizations we funded is an organization called Coral Gardeners that is focused on really restoring reefs around the world. And what they've recently done is created Reef OS, which is using AI, embedding it in the reefs around the world, and they're testing water temperature, salinity, the number of fish. They're testing the health of the reefs. And this AI and the collection of data is working incredibly well to give them ammunition to figure out where their resources should be spent. So that's just one example of an impact story out of the Ocean Health Collab. But you can, as you said, you can see it play an important role on so many dimensions. When you have climate change and you see rising seas and you can see how these storm patterns are affecting developing countries and folks that can't afford food, let alone these fisheries that are being depleted, AI is going to play a very prevalent role in helping solve some of these problems.
Only a couple of minutes left, but I'm very pleased to say audience participation is upon us. And when you're thinking about that 50 million that you get for just one particular philanthropic endeavor coming from your families, they need to have had the money from the exits. And an audience participant asks, are we going to see more exits? Are we going to see more IPOs? Or is there so much great money and capital coming from partners such as yourself that they can delay? Look at a DigitalBridge, one of your key ICONIQ investors. They can just keep raising money in the private market.
I think we are going to see a return to liquidity markets. I think the prediction was always sometime between 25 and 26 you would start to see these liquidity events happen. We just had Service Titan go public in December of last year. There's another number of IPOs that are slated for the next quarter. I think there was a period, 22, 23, where we had this rise in interest rates. There was a sort of a resetting, and I think we're coming out of that now. And the sense is that the next kind of quarters we'll see more liquidity events.
Will we see more coming together of sharing of generative AI ideas? I'm interested as this moment where we are upended by geopolitics, when we are trying to work out where the next value is accruing. What do you think gets us there? What do you think takes in terms of the wisdom that we need to see around corners at this moment? Yeah,
I think you are going to see greater collaboration, not just in sort of the tech evolution. You're seeing that through these open systems. I think it is important that we as a society start also collaborating and convening about thinking about these implications, both from a positive impact standpoint and how AI can drive social change in a positive way through innovation. But I also think we need to think about the secondary consequences of AI and how it's going to affect the job world, right? One of the most exciting things about AI is this notion of agents, this notion of digital employees and how we're going to be playing more of a manager role. But the implications of that down the road also have consequences. And so one of the things ICONIQ wants to do is spend a lot of time leveraging our convening ability to bring the right actors around the table to start thinking about how do we collaborate more? How do we think about impact at a greater scale using this amazing technology and this innovation that's coming out in real time, but making sure we're keeping an eye on the social implications as well.
Might be a few people in the audience who want to convene with you.
We would love that.
It's been a joy. We're out of time. Thank you so much for kicking off this second day of Bloomberg Invest.
Thanks, Caroline.
Wonderful conversation. Mike Anders of ICONIQ.
Pleasure. Thank you so much.
Please welcome to the stage Marc Ganzi, CEO of DigitalBridge, for a conversation with Bloomberg's Alex Steele.
Good morning, everybody. Good morning, Mark.
Good morning, Alex. How are you?
So I thought we'd start off with a super basic question. And my question was, hey, Mark, what's digital infrastructure? And I say it's super basic because I feel like we kind of know what it is, but I want to get your definition.
Well, I said, hey, Alex, it's the picks and the shovels, and it's essential plumbing to what makes AI and cloud computing and mobility work. So really, we provide the mission-critical infrastructure that enables mobile networks, really cloud computing, large enterprises, and all of the things that enable the digital economy today require that plumbing or that transport.
So if I was asking you this question 10 years ago, what would your answer be versus today?
That's a great question. I would say 10 years ago, we were pretty focused on building LTE networks and bringing that fiber connectivity to cell towers to provide the speed at which LTE was transmitting mobile data.
So it makes my phone faster.
Make your phone faster, make it more ubiquitous, and continue to provide a level of service to the customers where they could continue to proliferate their networks at that time.
And what would you say now?
I would say today we're really about enabling not only cloud and applications to the edge, but I think in AI we're really building kind of the next generation of infrastructure that'll power really compute, applications, consumer, enterprise, government agencies, machine-to-machine connectivity. The sort of paradigm shift in infrastructure today is, of course, at every iteration, it's build more, build it faster, and make it more ubiquitous. And I think that's the challenge we face today.
When Mark and I were talking offline, he was making a great comparison of the cloud and sort of the revolution in cloud and then where we are with that revolution in AI. Can you just walk me through that thinking? Because you played in the cloud, you've been doing this a long time. Where are we?
Well, I think, I like to think about these tectonic shifts in kind of 10-year iterations. I think when we started, building mobile networks in 1994, I thought that was a 10-year mission we were on. It turns out that's turned out to be a 30-year mission in building that infrastructure. When we were wiring up office buildings with high-speed internet here in New York City in 1998, 99, I thought the internet boom was a 10-year iteration. And I think as we look backwards and we look at public cloud, we started building cloud infrastructure in 2011. And ultimately, those applications became commercialized in, call it 2013 to 2016, really somewhat ubiquitous on your mobile device in 2016. And that's really when the public cloud companies began to monetize cloud and applications. I really think that AI sort of follows a very similar arc in terms of where public cloud goes. We've been building AI now for about 3 years. I think we're sort of, if we were playing kind of a 9-inning baseball game, we're sort of in the second inning, maybe third inning. But keep in mind, we're still building large language models. And those data centers are big and complicated. And there's a series of host of challenges which we can talk about. And then we start moving into inference in the next 24 months. And that's where really the power of AI, like Michael said previously, gets more interesting. When you're building inference, it's a lot like the proliferation of the public cloud, and so that should be another 7 to 8 years of CapEx spending, because even today, we're still building public cloud to the edge. Edge computing is a huge part of our business today. We've got really important businesses like Atlas Edge, DataBank, and AIMS in Southeast Asia, where we're building those critical workloads in the secondary and tertiary markets that really enable compute to work at the edge.
When you mean at the edge, you mean like over there? Like
physically, right over there, the edge.
Okay,
it's
meaning
right over
that
there.
like if I have AI on my phone, it's going to work a lot better if it's right over there.
100%. Latency is really the bottleneck in enabling compute to move quickly and to move fast and to ultimately work for that specific application or that enterprise or that government agency. So today, public cloud is on the edge. A lot of the workloads that are being built for public cloud today sit in tier 2 and tier 3 markets. So really sexy markets like Bluffdale, Utah, Overland Park, Kansas City. Woo, I know, I tell you, you're getting excited.
I'm from New York.
These secondary and tertiary markets are where those 5 megawatt and 10 megawatt leases are being signed for cloud at the edge. Inference will take a very similar blueprint and follow where public cloud went. And so this investment cycle we're in is not for the next 2 or 3 years. I tell our LPs, if you're going to invest in artificial intelligence infrastructure, be prepared to be investing for the next 10 years.
And what makes you guys really cool is you guys really build the stuff. You're not partnering, you're not taking a junior stake in another company, like you're the guys putting in the wires.
That's been our DNA. For us, it started, again, in 1994, we built our first cell towers. That was the journey for us, and today, we not only build data centers, but we build edge data centers, private cloud, public cloud, enterprise-grade data centers. And then, of course, we're building everything related to that, and that's the connectivity piece. So fiber optics are a really important part of delivering AI, and our businesses that provide that dark fiber, that conduit, and that connectivity is just as important as building the data center. And then the mobile infrastructure is growing at an incredibly fast clip as well. We're still in the early innings of building 5G. We're now kind of in the second phase of 5G infrastructure, which is what we call infill. And so as you saw probably from the earnings calls of AT&T, Verizon, and T-Mobile, they've all upped their CapEx for 25. Why? Because now 5G is being monetized, and there's other applications that are coming. So we're really busy. I mean, mobility, cloud, connectivity, all of these things enable the economy. And so, you know, at DigitalBridge, when we reported earnings 2 weeks ago, we actually have just recently, we're just up against about 100 billion of assets. Go back 5 years ago, we were at about 22 billion of assets under management. We've grown our business almost 5x in the last 5 years. So we've been incredibly busy, as you said, acquiring land, getting permits, getting will serve letters, dealing with supply chain issues, but really with a core focus on delivering for our customers.
You set me up for that. Did your job just get a lot harder today, considering all the tariff news and stuff?
I think, you know, tariffs are a narrative. I don't think tariffs are a reality.
Okay.
In our industry, at least. I mean, we have built a supply chain over the last, you know, decade to prepare for ourselves and to enable what we're doing. I think a lot of our portfolio companies, we own 51 companies around the world today. A lot of our portfolio companies are very prepared. We help prepare them. A lot of the purchasing that we do, for example, at Zayo, which is the largest long-haul fiber network in the US, it's one of our companies. We started buying fiber from Corning in mass bulk 5 years ago at the beginning of COVID. So we really felt like there was this massive data tsunami coming in terms of connectivity to cloud and to AI. And so Steve Smith and I made a decision that we were going to go out and really over-purchase on Corning, and that's what we did. So we locked up a lot of fiber, and while other institutions maybe have had challenges getting fiber, we didn't. We sort of predicted the amount of data that was coming, and so we purchased in advance of that. Same thing at Vantage, our hyperscale data center operator. We developed a great partnership with Siemens 5 years ago. We knew gensets were going to be super important to enable cloud computing and AI, so we created a partnership with Siemens, and we bought a lot of gensets 5 years ago. We got out in front of that before it became a real problem. So I don't know where tariffs go yet. I think you and I were talking about it earlier. I think it's early innings in terms of what the impact will be. The only area where I see tariffs impacting sort of AI infrastructure is really in and around specialized componentry.
Okay.
And data centers do have specialized componentries that comes from places like Taiwan, Korea, Germany. You know, these are absolute countries that are within the purview of what the president was talking about last night. So we'll have to see where the dust settles. A lot of discussion around, you know, leveling the playing field. But I also know that this administration really appreciates the race for AI.
Right.
He's made that a priority. The president talking last night about Oracle and Masa and Sam, he gets it. I think he understands the most important part of what we're doing is we are in an arms race. And I think we want to stay out in front of that. We don't want to fall behind it. So the hope is we can have a constructive dialogue with the White House and explain as an industry why some of this specialized componentry is going to enable America to stay first. Let's
play the fun game. Let's just pretend for a second that you do get tariffs on specialized components, right?
Yes.
I'm interested in what part of your job gets harder. Does it make it more time constrained? Like, do your projects get pushed out on a time level? Do they cost more? Do the contracts that you enter in become more difficult to come to an agreement?
So I think all three things are true.
Okay.
I think first and foremost, we have delays already. Supply chain is impacting our ability to deliver, you know, data halls on time, which allow our customers to move their servers in. There's delays of GPUs. NVIDIA is super backed up in terms of their delivery for their core customers. And so that's an issue too, that once we deliver the data hall, we turn over to hyperscaler A and we say, here you go, here's your data hall, move in. And they're like, well, we'd really like to, but we don't have the GPUs. And so I think that is an issue. I think that is a bottleneck that kind of clears itself up in 12 to 36 months, where you'll see a more normal cadence in terms of delivery. I think the other issue you talk about is just the cost side of it. Really, we felt the pain of cost in COVID. Mm-hmm. Inflation really impacted our cost of construction. So if you look at, you know, fiber route per mile during that sort of 5-year period went up about 20%. And it wasn't Corning, it was actually the labor. So to trench a fiber route from Northern Virginia to Columbus, Ohio, which has turned out to be one of the really hot routes right now in fiber, it wasn't so much that we didn't have the cables, it was finding the right labor. And labor costs went way up because there isn't exactly a dearth of ditch diggers. So that's a specialized form of talent, specialized form of engineering, more cost. Cell towers. If you go back 5 years ago, an average cell tower would cost us on average about $190,000 to $210,000 to build. Today, an average cell tower costs somewhere between $275,000 and $325,000.
Wow.
So again, that was steel cost, specialized componentry, labor. Labor has gone way up in our industry. And then the same thing in data centers. Data center costs have moved up. We could build a megawatt 5 years ago for $7.5 to $9 million. Today, a megawatt costs between $8 and $11 million to deliver for customers. So we really felt that pain, and it was more inflationary than it is tariffs. But I think what you're seeing today is really a landscape where everything does cost more, which gets to the third point, which is the conversation with the customer. And just sitting with customers and resetting some of those relationships. And we've been doing this for 30 years. So I've had these moments where we've had to sit down with customers and say, look, this is costing us more. You know it, we know it. We're good partners. We've been partners for decades. We need more rent. And so then begins the negotiation. And so we've had constructive conversations with our customers. Look, at the end of the day, the reality is most of our customers don't want to self-perform. Their balance sheets aren't equipped to self-perform. Not everybody has the balance sheet that Microsoft or Amazon has. And so there is an admission by our customers that they want partnership, they want collaboration. So when we're sitting with Hans at Verizon, it's a great partnership. And he works with us and we work with his team and we get to the right place. We just bought 7,000 towers from Verizon back in December. So we've had these long-lived relationships that are decades and going. And I've always told many of my my partners that, look, the most important thing with a customer is to be transparent and be quick. Don't be slow when there's a pricing discussion to be had. If there's bad news to share it with your customer fast.
There's a question from the audience, and this talks about that edge. I want to talk more about the expansion on the edge. Is it from the core to the edge, or is there an intermediate step? And so if I understand that correctly, it means like here's where the big stuff is, and here's where the city is. Is there something in
There is actually. So the core of the network is really what they call, for example, if you're dealing with AWS or Microsoft, they'll have something that's called a primary AZ. And AZ is an availability zone, which is where they put a lot of their compute. From that AZ, you'll move out, which are in primary markets, primary markets being Santa Clara, Goodyear, Arizona, Dallas, Texas is a primary node, Atlanta, Georgia is a primary node, Northern Virginia, of course, is the biggest presence of data centers in the US, and then you kind of move out to edge. And those edge markets are the next sort of layer, which would be in Austin, Texas, it'd be a Houston, we talked about Overland Park, and so that is edge compute. And then we have something that's actually called near edge. And near edge is actually where you build these, what we call sort of RAN hubs or edge data centers like near edge. And so there what we're doing is we're taking former central offices owned by the Bell companies, or we're taking a cable head-end feed that has generators, that has power, that has fiber, but it's a smaller building. So imagine it's a building that's 5,000 to 10,000 square feet. I'm not putting 100 megawatts into that facility. I'm actually putting in anywhere from 100 kW to 250 kW, and I'm stacking anywhere from 4 to 20 racks. That's near edge. So that's literally in the suburbs. So really pushing the compute to the periphery of the network. And then ultimately we think sort of micro edge will be at the cell tower, where maybe there's a software-defined component to the radio, where you're connecting to Netflix, you're connecting to Amazon, and you're actually providing that service adjacent to the radio, which will all be software-defined. So there's actually 4 layers to where networks are going today.
I could talk to you for like 25 more minutes, but we only have 5. So I wanted to get to the liquidity issue here. So I was struck by Dawn Fitzpatrick yesterday at Soros Fund Management. She was saying that she's very hesitant for private markets because she really wants the liquidity. That's why she's staying in public markets. How do you provide liquidity when you're spending lots of money building all this stuff out?
It's an interesting conversation we have with LPs. And by the way, 100% correct. The market is in illiquids. It is by nature illiquid. And so when you're in the alternative asset management space like we are, we're in the infrastructure space. Most of our funds, Alex, are 11 to 13-year fund duration. But that being said, we have to create liquidity. This is a market where LPs demand liquidity. So the number one question that I get on the road fundraising is, how are we doing on DPI? Tell me how Fund 1 is, tell me how Fund 2 is, Fund 3, explain your vintage and explain your DPI. So we've been really focused on that. So we said on our earnings call 2 weeks ago, we've delivered about $9 billion of DPI in the last 2 years, a little over the last 2 years. And we've had 8 different exits. And the other question then we get from LPs is, well, how do you generate that liquidity? And we said, well, it's really simple. You have to be very creative. Michael mentioned before me IPOs. IPOs were really not present in the last 5 years. So we took that off the playing field. Now that's coming back into the playing field. But continuation funds have worked really well for us, where we partner with an insurance company or an allocator that really wants access to a great platform or a great product. We did that with DataBank and Swiss Life. That worked out really well. We created billions of dollars of liquidity for investors there. We've done recaps. So dividend recaps where we work with an LP that really likes an asset. So whether it's a big sovereign wealth fund or a big LP, if there's a platform inside of one of our funds that makes a lot of sense for them and they want it to be a long-term hold, we'll go and run a process, and that process will ultimately create a value, and then they'll buy 80% of that platform in demand that we stay in for 20%, and that we roll our carried interest back into the vehicle. So continuation funds, sales to other LPs, and then of course sales to other infrastructure GPs. We work with a lot of the other GPs. You know, we've sold assets to GIP, we've sold assets to KKR, we've sold assets to Antin. And so I think today in this environment, with strategics kind of being on the sidelines and IPOs being now coming back in, we've had to be a little more creative in how we structure the liquidity. But at the end of the day, DPI is DPI. So we were happy to deliver $9 billion in DPI, and it's now allowed us to go back out and ask for more capital. So we are returning capital right now. It is part of our mandate, but at the same time, we're also raising a lot of capital.
You guys also securitized fiber optic cables, right?
Yes.
I don't get that. What does that mean? How did it go?
Well, I think asset-backed securitization is really has found a nice home in digital infrastructure. I did my first cell tower securitization in 2003, and what I figured out is my background was real estate, and ultimately we had ground leases and we owned land. So we figured out that we could put mortgages on cell towers. And then what I did is by having thousands of mortgages on cell towers, I could collateralize them in a pool, and I could sell them into a CMBS structure. We thought it was risky at the time. It's worked out pretty well. All three public tower companies now use CMBS as the primary mechanism to finance American Tower, Crown, and SBA. This securitization that you mentioned was our 53rd securitization that we've done as a firm. We've accessed over $30 billion of institutional capital, because really institutional investors love the long-term nature of digital infrastructure. Most of our leases on a cell tower are 25 years. Our data center leases are 15 years. A long-haul fiber route IRU is 30 to 50 years. So we have really long-term visibility in our cash flows. And oh, by the way, greater than 65% of our cash flows are investment grade. So it really sets up well for either an ABS or a CMBS. Data center CMBS is where we own the land. Cell tower CMBS is where we own the land. And then ABS is on a fiber route. So think of a fiber route. If you take a long stretch of conduit from New York City all the way out to, let's go back to Northern Virginia again, Data Center Alley, and you take that fiber route, and inside that fiber route, Alex, I have 24 pairs of dark fiber. So think of that as 24 unique floors in an office building, flipped on its side. And instead of leasing to a law firm or an accounting firm, guess who you're leasing to? Google, Amazon, Microsoft. And each one of those pairs, you can sell them on that unique route, because your route is super unique and it's low latency.
And I'm paying you no matter what.
And you're paying me no matter what.
Okay.
And so you're signing a 20 to 30-year contract with me. We look across the other side of the table and we see Moody's and Fitch and S&P, and they're salivating. Why? Because it's investment grade and it's 30 years of cash flows. Really easy to rate a deal like that. So we decided to start securitizing Zayo's fiber routes. The deal was 28 times oversubscribed. We raised $1.4 billion in 10 days. We tightened that transaction 6 times. I've never tightened a securitization 6 times. We got it super tight, and it was well executed.
Oh, perfect timing. We're over. I have like a zillion more questions, but we'll do this again. Thank you guys so much. I really appreciate it.
Thank you.
Such a pleasure.
Thanks, Alex.
Please welcome to the stage Rob Barnett, Senior Energy Analyst for Bloomberg Intelligence.
Good morning, everyone. It's a real pleasure to join you here today. Again, Rob Barnett. And I want to try to spend the next 15 minutes explaining to you why I believe energy is the pick and shovels of the AI data, or the AI gold rush. first I'll step back for just a moment. About a year ago, I saw Sam Altman, OpenAI CEO, giving a talk, and he said a lot of provocative things, but one thing really struck me on energy. He said a breakthrough in energy was necessary to fuel the AI revolution, and he spoke fairly positively on nuclear in that context. And then maybe a few weeks later, I saw the CEO of semiconductor company ARM make a comment that data centers could consume 25% of power demand by 2030. And at this point, my BS meter was kind of going off because I've worked in energy a couple of decades. Things don't typically move that fast. And I was thinking to myself, how could the creators of ChatGPT and all of this grand things that are happening with AI, a magical question-answer machine that almost seems conscious, not get what's going on with energy? So I started to work on the problem, and my initial hypothesis was that there's no way that AI could consume as much energy as some of the folks in the business were saying. But we ultimately arrived at a conclusion that confirms some of that thinking, and I want to try to unpack our assessment of how to think about AI and energy demand. So on the screen right now, we've got two charts side by side. The one on the left shows the annual spending on generative AI that the tech team at Bloomberg Intelligence thinks is going to unfold. So the basic story there is that by 2030, this could be $1 trillion a year business. I'd seen this chart from our tech team, and I said, hey, let's take this and try to back in to what it means for power demand in the US. And we like scenarios at Bloomberg Intelligence, so we thought, okay, we know that the tech industry evolves rapidly, and so let's think about a world where AI takes off, but we get more efficient chips, more efficient algorithms. That's your bottom line, the one in green. Or maybe we don't get as big of efficiency breakthroughs as folks would hope, and we get a lot of consumption and usage of these AI data tools. So that's the top line in blue. And so basically the top line shows you that AI data centers could consume about 19% of US power demand in 2030. Bottom line's closer to 8% in 2030. In either case, it's pretty substantial growth, but it's certainly a big window to think about. So let me illuminate that point a little bit further. So this is zooming in on that chart that was on the right there. You've probably heard about Stargate. Stargate is the OpenAI initiative. You saw Sam Altman, Oracle CEO, SoftBank CEO, up with President Trump earlier this year talking about it. It's a $500 billion data center initiative. And if you think about $500 billion being spent on data centers, well, how much power demand would that consume? A good rule of thumb today, at least, is that a data center, for every $1 billion in CapEx that you do on a data center, it translates into about 0.4 terawatt hours of power demand. So if the 500 billion Stargate initiative gets built, that effectively would double power demand from data centers in the US, from one, albeit large, project. And so I think we've got a cool tool that we did as part of our analysis where you can go and sort of look under the hood, play with our assumptions if you'd like. We also approached this problem from a bottom-up perspective and said, look, well, how much energy does each GPU that NVIDIA is going to sell consume, and how many GPUs are they going to sell this year, next year, based on consensus? And you get very similar numbers. So I think my initial skepticism, or if you're skeptical of the energy component of this, I believe it's real, and we've got some cool tools and data to help you sort of confirm thinking around that. Now, There's a couple other trends that maybe I'll just mention quickly. The first one is that electricity demand is growing for a couple of other reasons in the US. One is manufacturing. So, and my slide's not advancing. I'm not one to dwell on slides, but if we could go to the next slide. So this is the amount of manufacturing spending that has unfolded in the US over the last 25 years. And you've seen a real surge in manufacturing, partly because of the IRA, the Inflation Reduction Act, partly because of the CHIPS Act. By the way, this is not intended to be a sort of politically focused conversation, but we actually think the CHIPS Act and many components of the IRA are going to survive the current political environment. Happy to follow up with any of you if you want to chat about that. But this is another factor that's helping to drive up electricity demand. Electric vehicles would be another component. So you've got three pillars of strong electricity demand growth. You've got AI data centers, resurgence of manufacturing in the US, and vehicle electrification. And then you sort of have to say, okay, well, if power demand is going to grow, what kind of electrons are going to meet that power demand? The general view from us, at least, is that we're going to see some combination of solar, battery storage, and natural gas are going to be the big winners of this increase in power demand that could unfold over the next 5 years. A very interesting chart up on the screen right now. This is the assessment of all projects out in the US that have requested to be connected to the grid. And there's over a terawatt of solar projects, about half of them have storage coupled as well, that have said they want to be added to the US power system. For context, the US power grid has 1.25 terawatts installed today. So basically there's enough solar capacity that's been proposed out there to essentially double US power capacity. The next biggest component of projects that folks are building is storage, then wind, and then gas and other comes down the line. So solar really is the type of technology that is moving very quickly in the US right now. And there's a lot of reasons why that's true. One is simply because you can build solar very quickly. And speed is particularly important to the folks trying to build data centers. The hyperscalers aren't looking to get their data centers built in 2035 or 2030. They want them built as quickly as possible. Solar is the technology that can move most quickly. If you follow GE Vernova, they make gas turbines. I think they've got a 5-year backlog. So, if you want a new gas turbine, sure, you can make an order today, but it's going to take time to get that equipment. So we think this is an opportunity for a lot of the US listed solar companies. Just up here on the screen right now, context, they had a pretty rough 2024, despite all of the cheerleading and optimism from the President Biden and his team. 2024 wasn't a good year. If you want the history lesson on what happened there, please do follow up. But this year looks like a turnaround story. Next year is probably a continuation of that turnaround story. And what's driving that turnaround, AI data centers, is probably a big component of that. And we think it probably gives upside to consensus in terms of sales for companies like First Solar and others that are geared to this thesis. I mentioned gas as well. So we all know that solar is not available at night. I feel like I occasionally need to point that out to satisfy the folks who regularly like to point it out to me. But it pairs well with storage. It also pairs well with natural gas. And so we do think gas is a big part of the AI energy story. Gas could increase anywhere from 3 to 10 BCF per day by 2030, based on our analysis of the AI data center piece. So this is not LNG, this is not any of the other things that are sort of out there driving some of that fundamental gas demand. 3 to 10 BCF per day potentially comes from data centers alone by 2030. It's a pretty big number if you don't think about gas markets very much. And I want to also hit on the idea of nuclear as part of this, because, as I mentioned, Sam Altman and many of the others speak very favorably of nuclear in the US. So chart on the screen, just giving you some context here. The blue line is monthly generation from wind and solar combined. Nice upward moving trajectory. Nuclear, pretty stable through time, and this chart goes back 25 years. The interesting thing about nuclear in this context is you've seen some pretty big headlines. You saw Microsoft announce a deal with Constellation regarding 3 Mile Island and restarting that facility. Amazon reached an agreement with Talon Energy and their Susquehanna nuclear station. And so you are seeing nuclear really enter the verbiage of the hyperscalers. They are interested in doing that. But the only issue is that beyond the restarting maybe a couple idled reactors, buying some capacity from reactors that are already in place, the difficulty with nuclear is that it is a technology that you have to think about in terms of decades or longer. Many of the hyperscalers have investments or agreements related to things like small modular reactors, SMRs, maybe even fusion is being worked on. But we think that in the 2030 timeline, probably very little chance any of that nuclear capacity is online. 2035, 2040, sure, why not? Lots can get done over a kind of 15-year time horizon, but we definitely don't see it in the near term. So that brings us back to, okay, so if you got rapidly rising power demand in the US, how are you going to fill it? You're going to do some combination of solar plus storage plus natural gas. Wind will also be in the mix, although if you're following the current administration, wind is not as popular of a technology here at the moment. So with that, I will just briefly conclude with, there's a QR code up on the screen. If you scan it, you can go download a deep dive report that we've got on this topic if you want to go deeper into the ins and outs of this particular thesis. My contact information and everything is also available there. And so with that, I'm going to conclude here, and I want to thank our title sponsor for today's event, which is Invesco QQQ, for supporting this innovation stage. And I just want to reiterate that we're just getting started today, and Bloomberg Invest is continuing upstairs, so please make your way there now.